In this video, I am going to introduce to you Quarter 5 and the Venture Capital Fair. This will be probably the most task-oriented and intense quarter for your simulation. We are going to prepare the video in three parts. First, I'm going to talk to you about what's new in Quarter 5. Then I'm going to talk to you about what venture capitalists want as information. And I'm going to also introduce to you some ideas for your venture capital negotiations and presentation. In the end, I'm going to give you some pointers in regard to what should be in your presentation. So let's talk about what's new in Quarter 5. First and foremost, you are now able to do research and development in regard to product design. This is huge because now you have the opportunity to actually produce products with design features that reach into the premium segments and can make customers in those premium segments satisfied with the performance of your product. We also have debt as an opportunity, and debt management will be important for you. You have now more quality control measures that you can invest in. And of course, we have the business plan with extended pro forma planning and a tactical plan for year number 2. So basically, you are in the quarter in which you have to make plans for the future, specifically the real implementation of your business plan into the global industry. Really, you are now in the growth phase. And so your goal is to speed up the adoption rate with new brand features, expanded or new sales offices, expanded plant capacity, and all of that with combination of your competitors doing the same will really push the industry into a heavy growth phase. The business challenge is, of course, that you need to start making profits. You have had the ability to set up your business and run some losses through your capital that you put in as the owners of the company. Now, as you are looking for external capital infusion, you need to start looking at creating revenue that is larger than your cost base, and you're going to create profits so that there is a return on investment for your external investors. We are really looking at a good profit basis probably in quarters 7 and 8, because you do have a lot of investments in quarter 5 and 6. So look at it from the medium perspective. What's happening in quarter 7 and 8? How can you reap the benefits of your plans and investment? So what do you do when cash and income from current operations are not sufficient to fund your new business development? You are going to be in that situation. You can do it through expanding owners' equity, and we are doing that here with the venture capitalists, bringing in new investors, or we can leverage it through our investments, and we can borrow money from others, in this case, of course, the banks. So with the venture capitalists, you're able, or you have the opportunity to raise up to $5 million, because venture capitalists are willing to invest up to $5 million. And they may actually ask for up to 60% of the company in exchange for their investment. It all depends on what your plan looks like and how successful the investors think your plan will be. So we usually see a large variation between firms in this stage based on number one, their overall strategy, number two, where they are in Q6 results, and how confident the investors are that the strategy is good and will lead to an acceptable return on investment. And then you have the ability to borrow money either in short-term bank loans or long-term bank loans. So we know from Q4 that demand is up for the entire industry, and it's only now entering the growth phase, so demand will be expanding quite a bit. You have established yourself in year one as a competitor, and hopefully you have not been bankrupt. So in other words, you're a viable competitor. Now, you probably would benefit greatly from expanded distribution because you would drive up unit volume, and with expanded unit volume, usually you reduce your unit cost in production. You have the opportunity to create new brand features that would bring in new markets, and therefore you are going to have to invest in R&D. These brand features that you can invest in with R&D will increase customer satisfaction, and of course that means that there probably is a demand increase. If you have all of these demand increases, you probably need new production capacity and quality improvements that will allow you a substantial market expansion. Which brings us to what venture capitalists want. They want a plan. So in other words, you need to convince them that you have a strategic plan that makes sense. That includes having objectives with the results that you are trying to attain, and these results need to be very specific and have a date. Q8, Q7, Q6, you need to be very specific in the objectives that you're pursuing. Based on the objectives, you of course have to develop a set of carefully selected and integrated business priorities so that you can achieve the objectives. Based on this strategy and the integrated and carefully selected business priorities, follow the tactics. You have to actually spell out the actual actions and operations that are necessary for you to execute the strategy and achieve the objectives. You know a couple of these sayings, these quotes, I love them. The best planned strategy will not survive the test of battle. Same in our simulation. Even though you might have a good strategy, be prepared that over the course of quarters 5, 6, 7, you might have to change some of it. Next one is plans are worthless, but planning is everything. That is actually something that is really important. The business plan that you are developing and the strategy and tactics that you're developing for quarters 5 and beyond, and for your venture capital negotiations, is actually an exercise that drives home the point that you have to have a plan over multiple quarters. You have to have like a red path that you're following, and that path has to be synchronized with the overall strategy as well as the objectives that you're achieving. That exercise by itself is extremely useful for going forward. And last but not least, the devil is in the details. That's the reason why we are doing the performers and the tactical plans. Because once you do your tactical plan and the performers, you will see gaps, you will see issues where you feel it's not synchronized with the strategy, and hopefully you're going to have a very good constructive discussion amongst your group members to identify these gaps and create a synchronized and integrated strategy with the tactical plans and of course performers. Last but not least, it is better to have a Class A team with a Class B plan than to have a Class B team with a Class A plan. Why is that important for us? Because the venture capitalists will ask specific team members for feedback, for clarification. And you better make sure that every team member is able to answer the questions for their specific responsibilities. Venture capitalists need to feel secure that everybody on the team knows what they're doing and therefore having a good chance to recoup their investment. So, venture capitalists want a plan that includes strategic analysis with the overall corporate strategy and the functional strategies of marketing, manufacturing, human resources, finance, as well as the follow-through tactical details that are then also explained in the pro forma financial statements. In the end, the venture capitalists want to know what's in it for them. So make sure that in your presentation, you also have not only the ask, which means how much money would you like to have, how much equity are you willing to release for the investment, but you also have to make a prediction on what should be the return on investment for your investors. That helps in the negotiations to gain confidence from the investors and get as much of your ask fulfilled. The tactical plan follows from the strategy, as I said before. It's a series of the interconnected functional tactics that are purposely organized in sequential order to make sure that you achieve your strategic goals and objectives. So you need to work it in sequential order and build on each other. That is going to take some time. So I strongly suggest you start early with the business plan. So let's look at the tactical plan. I mean, at this point, you are familiar with the different specifics of decision-making entries. What's new is the R&D. So you now have the opportunity to specify what R&D would you like to execute in quarters 5, 6, 7. I'm not sure that there is a need for doing anything in quarter 8 because you probably want to reap the benefits of your investments in quarter 8, given the fact that we are only running it to quarter 8. There are opportunities with longer classes to do it to quarter 12. And of course, we also have a final stockholder presentation where we are going to ask you to talk about what plans do you have for the future. If you're swimming in money and you have a lot of money and positive cash flow and you have satisfied the return for investors, you might even invest in R&D in quarter 8. Usually teams don't do it to make sure that they have the best financial picture in quarter 8 for the stockholder report. You know that R&D has a time lag until the results of the R&D lead into a new design, into a new computer. So make sure you invest right away in quarter 5 because you probably have the return or the benefits of your investment only in the quarter number 7 and 8, of course, following. You have to be specific in the different specific functional areas. For example, sales offices, how you expand them. We have to have specifics in regard to your pricing and other functional areas. You need to project your revenue. We know historically quarters 1 through 4 what you had, but you have to also project it for quarters 5 and 8. This is very important because venture capitalists will actually look at that in very detailed form to see whether they can trust you and whether they are willing to invest and can somewhat estimate their potential return on investment. Let's look at the venture capital negotiations. For the online course, Our procedure for the Venture Capital Fair will be that you're preparing a presentation, and that should be about a 12 to 15-minute presentation. You're going to post the link to the presentation, and I propose that we are going to use Zoom so that we not only have the PowerPoint, but we also see you in your presentation style so that you can exude confidence. The venture capitalist will review your presentation and pose questions in order to better understand your plan, as well as your team members, your leadership team, as well as kind of getting a hold of the risks and reward of an investment in your firm. Your teams have to respond to these questions within 24 hours of being posted, because these question responses will actually have an impact on the investment. The VCs have a decision-making procedure. They will assess your risk or the risk of an investment in your firm, and then decide on the amount they would like to invest, as well as the price at which they are willing to buy stock, which means based on the price, there is a certain percentage that you have to give up. Usually I encourage investors to consider a stock price between $70 and $120 per share, but, and this is important, venture capitalists are independent investors. They do not have to agree to invest in your firm. This is important. They do not have to agree to invest in your firm if they feel that your plan is not thought through and lead to sustainable success. In case you don't have an investor investing in you, or you don't get all the money that you asked for, we have the Fast Eddie Venture Capital Fund. So the Fast Eddie Venture Capitalist Fund steps in when venture capitalists may not give you all the money that you request because they're worried about the balance of risk and reward in your plan. Fast Eddie Venture Capital Fund will make up the difference. However, their investment will be at $10 per share below the lowest share price for the industry. That means all the 5 firms combined in our industry. Now let's talk about a little bit what needs to be done in the presentation. Your business plan should be a PowerPoint presentation. Technical plan and pro forma financial statements must be included in that PowerPoint file. That means that you have to make some layout decisions, because as you will see, there's a lot of information to be put on a slide. You will not be able to put all the information on one slide. You have to decide on how to lay out for legibility as well as relevant information that an investor wants. That's a challenge. I alert you to it right away. It's probably a good idea for you to think through how you want to present your tactical plan and your performers. You probably see $5 million invested already in your simulation worksheets. It's just there for planning. That doesn't mean that you have already been awarded the $5 million. You will adjust the amount of stock and the stock price paid by each investor after the investors have made their decisions. Because of the difference that might be between your ask and what you get, and whether you want Fast Eddie or not, given if you don't get everything you want from the investor, we will give you some extra time to make and finalize the quarter 5 decisions. Make sure that you understand that you can start in pre-negotiations with other teams for research and development partnerships, if you want to work with other people's money and not go it all alone. In regard to the presentation, the president for Q5 in Venture Capital Fair is responsible for the presentation. That includes its delivery before deadlines in our Canvas Dropboxes, assignment Dropboxes, and making sure that the layout and the information is complete, legible, and makes sense. In the presentation, the VP of Finance and Accounting owns the tactical plan, the pro forma financial statements, and should be the one that is ultimately signing off on the stock price negotiations, if there are any. You need to make sure that you have a stock price and an investment amount in your presentation as an ask, so that the venture capitalists know what you want. It is my recommendation that your ask should be one of the first slides, so a venture capitalist can review your strategic plan, your tactical plan, and your performers under the frame of mind of what you're asking them to invest. Learning points are many. Q5 is a heavy quarter. Basically, you're learning how to manage the future by taking the initiative to expand your resources and make sure that you have a very clear idea and plan going forward in the future. Your learning points include your skill set for strategic and tactical planning, with the ability to specify objectives, perform the strategic analysis that is necessary after your first year, evaluate your strategic options because of the information that you have from the marketplace and potential strategic action by your competitors. Choose a strategic direction for 4 quarters with the appropriate strategic thrusts. Make sure that you have a skill that can time different tactics over the 4 quarters and that sequence makes sense, as well as trying to really understand how you work with investment money as well as debt to support your tactical plans. Projecting cash flows is really important because you do not want to lose out on research and development opportunities by not having enough cash, and working with debt to have enough cash flows is important, as well as evaluate for yourself the feasibility and effectiveness of your strategic plan. You will see that cash is king, and you will understand after Q5 how profit is different from cash. You will also learn how to value the firm and estimate return on investment. And it's kind of interesting, but you will see that at the end of the game, you can't go to Hawaii because of your market share, because you need to create wealth. If wealth creation is the goal, it's usually an ongoing sustainable concern that you have to work with. You will have to work on really showing your ability to competitively think. You do that by either competing or cooperating, and that means you have to really think about strategic alliance with competitors to multiply resources and developing markets more quickly. And of course, we know that you will help the competition because you're multiplying resources and developing markets more quickly, and you share the resources. So you have to really find a really strategic point of view on who you want to work with if you decide to work with somebody. It's basically game theory, right? You heard about the prisoner's dilemmas, and therefore you need to figure out which 2 partners would benefit on working together, or with which partners you don't want to work with because they will take advantage of you, given the fact that you might be an unequal footing in regard to your market power or, for example, in your resources. And that means you have to start negotiations. Negotiations is a major issue in quarter 5. It doesn't start in quarter 6, it starts in quarter 5. So I refer you again to the mental discipline of our business simulation. We are now in the full-fledged midst of everything. We had feedback on market reactions for our activities. We have a business strategy that we had developed in the beginning, and we now see whether we have to make changes based on the assessment of the business conditions in the marketplace.